All right. G'day, everybody. How's everyone doing? I hope you enjoyed listening to Serge. Serge is a great trader and a good friend of mine, and thank you everyone and Renee for putting together such a great webinar today. So we'll be kicking things off here. We'll get straight into things. We're going to be talking about smart money systems, and I probably should probably should update my introduction because it's been about 17 years now. I think we wrote that introduction around 6 years ago. But yeah, as Renee said, I mean, I'm very much focused on systems. I like to find, the kind of figure out the puzzle on what's really going on behind the scenes, and this is where smart money becomes a very powerful tool to. Especially in markets like this. So a standard disclaimer, we're going to be talking about live markets. I'll be talking about positions that I'm currently in or ones we've traded, and but of course it's not a recommendation to buy or sell any of the securities discussed. And let's get going. I'm just actually I've been trying to load up my Interactive Brokers account here for the last 15 minutes, and it just keeps saying there's a server error. I'm not sure if anyone else has been having that problem. It's on Interactive Brokers, but anyway, we'll continue on without that. So again, today's process is to talk about systems. So, I mean, having been in the mentoring and trading industry for quite a long time, Acorn's been around for 11 and a half years now. Throughout the thousands of people we've trained, I think one of the most consistent things that people say they're looking for when we say, what would you like to learn from us? And it seems to be consistency. Consistency in results in terms of month-to-month returns, consistency in knowing when to get in, when to get out, how to set entry and exit points and stop losses, and all those kinds of things, and of course consistency in how to find the opportunities. So it's important to get consistent results that you have consistency all the way through everything that you do, and for that you need a system. So what Acorn very much focuses on is a systematic way to approach things, and much like perhaps Serge talked about in terms of his top-down approach, we like to look at that kind of top-down feel of what's the overall bias of the market, what are the patterns and smart money telling us where things are going, and for us then looking for the highest probability patterns where smart money is either loading up in the case of a long, or jumping ship in the case of a short, which has been most of the situation since June of this year. So that's basically our whole shtick. Now, obviously, we've been in a very turbulent market. I hate hearing people say it's a chaotic market, because it's not. It's been a very technically driven market. It's been a very well behaved market. It's turned where it should. It's dropped when it should. So perhaps people feel it's chaotic, again, because they haven't had a system to trade it to identify these turning points. But we're going to be talking about that today. But this last few months has been, this last 12 months has been the best year for Acorn, I think, in history. Since maybe 2008 was our last second best year, because there's so much volatility, and that's great for a trader if you know how to pinpoint these entry and exit points. But if you have a look at the overall market conditions, this is why we've had such obviously a big pullback. I'm not going to get into an argument over economics and whether the economy is good or not, because look, that's not my specialty at all. I'm not an economist. I'm not a fundamentalist, and I don't have the slightest bit of interest in what the Fed's saying or things of that nature. What I'm interested in is, where is the data going? Where are the patterns telling us? And where's the smart money going? So regardless of the state of the economy, simply put, prices were overvalued. We had a market that was, from a price to earnings perspective, more expensive than it had ever been in history, based on the price of the stock compared to how much money the company actually makes. So whenever you get to overextended levels like that, naturally there should be a pullback. How bad that is, we'll find out. But regardless, the takeaways from these kinds of market conditions is that we've been at dangerous levels, and the market conditions have been perfect for a trader to really kind of pull out some great results. And this is why you need to have that edge, and why that edge, I believe, is smart money trades and smart money setups. So just to give you an example, one of the questions I kept getting up, because we have several portfolios that we trade. We have an Acorn fund, we have an Acorn more aggressive trading portfolio. I have my personal portfolio that I trade and invest with. But one of the questions I kept getting asked last year was, look, do you need to have a really big account in order to trade these setups? How much money do you need? And a lot of people felt they didn't have enough money to be able to really bankroll a great trading path. So back in when we saw this market drop coming back in September, I funded a new account with Interactive Brokers for the sole purpose of doing only Acorn trades, only trades that we had sent out to our students, and trading those with an account starting with 25,000 US, which is a kind of a mid-range average of what most people start with. And I just took the screenshot from that specific account before this webinar today, and you can see that over what most people consider to be a chaotic market, we've actually seen since September 28th through till January 4th, a 77.71% rate of return over that period. So over 3 months, that's not bad by anyone's standards, and that was following the exact strategy and the same alerts that we sent out to all of our students. So I guess the key takeaway is that, this is stuff we believe in. It's stuff that's a kind of a smaller portfolio. We'll talk about some larger ones as well. But we practice what we preach. And I think most people fail in the market because that's where they get caught up. They don't know how to execute. They don't have that system to give them strong buy and sell indications where emotions may be high, especially in these markets. When emotions are high, it becomes extremely difficult to execute, because you may have made a lot of money and you don't know when to pull the trigger and get out, or you may have lost money and you don't know when to cut your losses and put a stop loss in. It's emotions get very high when things are volatile, and that's the opposite of what you want. So most people then lose money for that reason alone. All right, so the whole idea is to recognize that this is the goal of smart money. The goal of smart money is to keep you emotional and flood you with noise. That's because their whole agenda is that if the market's about to top, they want you to buy at the absolute worst time so they can sell their position to you. Just on that point, think about the highest probability pattern. The highest probability pattern to call a top in a market, right? The highest probability bear signal in a bull market is a head and shoulders pattern. And just think about what it's specifically designed to do. A head and shoulders pattern obviously looks like this. And this was exactly actually how this market topped. It's how 2008 topped. Every major crash has often been associated with a head and shoulder pattern. Think about why this is so powerful, because it's designed to break out a fresh new high, to sucker in all the retail buyers as the smart money sells in that peaking process. This is how the system works. So, rather than getting upset by it and saying, well, look, it's unfair, the market's rigged, this is garbage, like for me, 16 years ago, I thought, instead of trying to compete with this or fight it or outsmart them, let's just play by their rules. Let's follow what they're doing. Let's turn off the TV. Let's stop listening to the talking heads on BNN and CNN and Fox and wherever, and let's just look at where their money's going, because that's the best indicator of all. If you want to know the truth behind any issue, especially regarding finance, just follow the money crumbs. That will lead you to the correct answer, and often a lot quicker than doing it any other way. And this to me is a far simpler way um, to approach things. Let me just have a quick look at the question box. In this market volatility, is it a good idea to buy call and put option trades? I've been buying calls and puts, but I've had stop losses and exit strategies on all of them. You know, where's my target? Where's my stop loss? So trading calls and puts much like the exact same way I would a stock. And I'm still doing that. Okay. 660 down one day and 700 up the other way. Can you make money in options trading? You can. We'll talk about the market conditions though in a minute. So let's get over to talking about the market structure. Okay, so obviously, if we want to talk about why smart money is so important, I just want to go through a couple of basic facts for the benefit of people that may not be aware of this. I'm sure most of you are, but obviously some really basic things to get out of the way is that if you want to know what's going to make price go up or down, it's not fundamentals, it's not the Fed, it's a more simpler answer. It is volume. Volume makes something move. So who controls the volume? And the recent report from JP Morgan estimates that 90% of volume is on a daily basis comes from algorithms. Algorithms which are pattern driven. Okay? Pattern driven. So they say, I'm going to buy here and sell here based on things like a head and shoulders pattern. These patterns have worked extremely well. This last 3 months, I haven't seen patterns and technicals work as well in my 16, 17-year career. So the first point is that volume makes its decisions this way, and that's why it's going to go there. And it's not just day traders anymore. It's now also managed money. So 60% of managed money globally is also managed by similar patterns based on JP Morgan's estimates. So it's very important, if you want to have an edge, to be understanding the rules. That's 90% of the daily volume and 60% of the managed volume follows. You want to be on that team. The beautiful thing about it is it's actually quite easy to figure it out. So what we're going to do is jump over and have a look at those systems, and there's two of them, two core systems that we use to follow this. One is the pattern, things like head and shoulders, upward channels, etc. These are the playbooks of smart money. These are the rule books of smart money. And then looking at smart money itself, looking at when we have a high probability pattern saying things are going to go down or up, how do we increase that probability even further by looking at where the big money is going, whether it's bond traders, central banks, or in a lot of cases, the actual insiders themselves, such as the CEO and CFO and the chairman of the board. If we can get all of those things going in unison, then we have our answer. So, because ultimately, there's only really two questions we need to answer to make money consistently, and that's one: what direction is the market likely to go? That gives us our bias. And then secondly, based on which direction is most likely, how do we find the highest probability stock or option plays to trade? So let's start with the market. Let's start with the stock market or the S&P. Hang on a second. All right. Okay, so it is, let's just have a quick look here. All right, can everybody see the chart coming up? Everyone got that? Let me know when you do. Excellent. Okay. So the first thing I want to break down for you is how this whole thing was predictable, because these are valuable things you're going to be able to use in any market condition. So firstly, let's look at the S&P 500 and let's analyze the pattern first, and then we'll look at smart money as well. So when you look at a chart, the first thing that you need to determine is what kind of pattern is controlling that equity or that index or that Forex pair or whatever. What pattern is controlling it? Now, there's two core types of patterns, two core groups that make up the universe of patterns. One, I think, is oscillating patterns, and the second is momentum patterns. Now, these two are so different from one another. They're as different, I would suggest, as a long is to a short. So one of my biggest gripes with a lot of ways people have learned to trade is that a lot of people have never been properly trained on this absolutely fundamental skill of knowing the difference between them. How many people here are unfamiliar with the core differences between oscillating and momentum patterns? And that'll determine how long I spend on the topic based on the group's understanding of it. Okay, a few people. All right. So with the basic differences is that an oscillating well, let me start a different way. That momentum patterns are driven by moving averages. The support and resistance that matters most are the moving averages, the 9, the 5, the 9, the 20, the 50, the 100, the 200. You know, these are going to be the support and resistance levels that matter. So if a stock is in momentum and it's going up the chart and the moving averages are behind it, this is a scenario where you don't sell on the way up. As long as the support is underneath the stock, in other words, the moving averages, you hold it, because as long as something is above support, you stay in it. This trade is still valid. You exit the trade when the stock drops back below that support. So the way we enter a momentum trade is categorically different to an oscillation trade, because we enter a momentum trade, let's say that's the moving average. We enter a momentum trade when it's above support, which means it needs to go up first and cross the moving average. So you're buying on the way up. All right, and then on the way down, we're selling when it breaks that support. Pretty simple, right? Now, there's other rules that change as well. When we're entering a momentum trade, we might use things like relative strength index going up over 30 or up over 50. We might look at the MACD, turning positive. We might look at on-balance volume. We might look at directional movement. You know, these are some of the types of indicators one might use if you're in a momentum scenario. But here's the thing. None of that works if you're oscillating. Forget your MACD, forget your moving averages, forget your directional movement. You can forget all of that, because it doesn't work if we're oscillating. If we're oscillating, the moving averages don't matter diddly squat. The core systems of support and resistance are the straight lines, right? The diagonal or horizontal lines. So if we're oscillating, our entry changes completely. We actually buy on the way down. So we're buying and catching the falling knife. We're buying as a stock is actually dropping, and we sell on the way up. We don't expect it to continue breaking through levels because it doesn't have momentum. It's going to hit resistance or support and change direction. That's why it's oscillating. Instead of using those previous indicators, we use things like Bollinger Bands, Keltner channels, what else? Those are some of the key ones anyway, money flow. So I guess my point here is, maybe spent a bit too long on that, but I wanted to make sure everyone was aware that the two are categorically different. So when we look at a chart, we need to determine which is in play. So if everyone can see here on the chart, the S&P 500 from this point to this point, okay, from that point to that point, the stock is in a momentum scenario. Okay, we're in a momentum scenario. You can tell this by, if you look at those moving averages, can everyone see that the moving averages work? The S&P 500 keeps riding up those moving averages like a caterpillar, and very, very, very rarely ever breaks through the moving average. And if it does, it bounces off the next one. Can everyone observe that? Okay, so that changes. We change from momentum to oscillation right up here at the top, where all of a sudden we hit some kind of resistance and we slice straight through all of those moving averages without a care in the world. This tells us that we have, as soon as it starts to happen, that we have changed from momentum to oscillation, and it's going to go back and forth between these two systems. So the moment that happens, we start looking for what pattern is occurring. And as soon as we had our first two reversal points, as you can see, here and here, we had our first line. We had the first support level that we were confident of. All right. Now that meant that that we still had to figure out what was on top. We didn't know at this point whether we were dealing with maybe a horizontal line here, or whether we were dealing with some kind of diagonal line. We weren't quite sure. It could have been either. So as the stock rallied up, you can see that what occurred is the pattern on the S&P 500 oscillated all the way up . Okay, and then what we do is we duplicate that line. And can everybody see? So of course, right now we're in oscillation territory easily. So we can actually take the moving averages off because they don't matter. They don't help us make decisions at all. Can everybody see that we were clearly in an upward channel inside this larger pattern? Okay, very, very important, because it tells us the rules of how to trade it. So as we see the upward channel go up, firstly, an upward channel is a bearish pattern. An upward channel tells us that what's going to happen next is a breakdown. So a lot of people think upward channels are bullish. They're not. They're bearish. They tell you that it's about to break down. And typically that happens after 3 touches along support. 1, 2, 3. The next touch is a breakdown, statistically. So we knew we had a bearish pattern. We knew that the macro pattern was oscillating as well. And if we then take this, if we look at what happened here, where the S&P 500 reached this, what most people would have considered to be a very strong potential double top, the actual volume in the market, let me add volume onto the chart, because this is actually just a brand new computer I'm using, so my indicators aren't all set up yet, but look at the volume. When the market when the S&P broke through what should have been a potentially incredibly powerful level of resistance. Let's just go over there. Look at what happened to the volume between those 2 days. So, question to the audience, did anything really of any significance happen to the volume as we broke through critical resistance? No. In fact, the volume was below average. So what that tells us, and what that tells you when you're looking at any kind of level of support or resistance, what was that actual resistance? No, it wasn't. Otherwise, the volume would have changed. So that line doesn't matter at all. And that left us with the only other possible conclusion, which is that we were in a much larger upward channel, totally parallel. So what we had was this perfect storm of one really large upward channel, and inside it, it was building to its peak with another upward channel, both high probability bearish patterns. Okay, both high probability bearish patterns. So let's look at the way it peaked. So this was why we were able to call the top of the market right around the end of September and early October and traded it. But if you look at the way that this market actually peaked, what you'll also see, and it might be a little bit tough, but in the short term, what you actually had was a downward neckline head and shoulder pattern right here, which is the highest probability of all head and shoulders, is a downward neckline head and shoulder. So you have two upward channels, a head and shoulders pattern, all three time frames basically saying short this. So this was the pattern of the market. So where was the market going to go in this crazy, chaotic volatility? Well, let's have a look. Let's follow the rules of the pattern. We measure the distance of the channel. We've had three touches. That tells us we're about to break down. So where is it going to break down to? Well, we look at the breakdown area. That tells us where. That told us that the short-term target was a short from here at 29.40 all the way down to 27.40. And that played out perfectly. That's basically exactly where the market dropped to. That's where you take your profits. And then we had a rally back up. The overall macro target, of course, was all the way down to the bottom of the larger pattern, larger channel. So as we dropped all the way down to here, this is again where we took profits. So the question of the gentleman earlier, I believe, Guillermo, is it a swing traders or day traders market? It's both. I don't day trade. I only swing trade. So all of the positions I'm in and have been in for the last 3 months, I mean, in general, it's the same, but I mean, focus on the volatility of the last few months. They've all been things I've held for weeks, if not months. And then as we hit these high probability turning points, that's where you can shift gears. Right, so we had a rally back up. Now, remember that we are in an oscillating pattern, right? So as we rallied back up, what does that mean? It means that we're not going to get momentum. So when I watched all these kind of TV pundits and people saying, "Oh, look, the S&P 500's crossed back above the 200-day moving average," which is now what you can see on the chart. I was quite vocal in saying, "Look, that doesn't matter." Clearly, these people don't understand the difference between oscillating and momentum. If we're in oscillating markets, the 200-day moving average doesn't matter. So as we rallied through it, This was where we then got short again as we hit that horizontal double top. And that's where we loaded up on our new shorts and have been holding those all the way through until the end of December. All right, so I want to take you through this process, and of course, the other reason why we weren't worried about the bounce in the S&P 500 was that like an upward channel, we had one touch, two touch, three touches along support. So based on the rules of the pattern, that told us we were about to break down anyway. And how much were we going to break down? Well, if you measure that out, we're technically not yet at the target. The target's 2,300 on the S&P, but we've gotten pretty damn close to it at 2,345 or so. But as you can see, beautiful, beautiful moves. Okay, so that's all I'm going to talk about on the pattern perspective, at least on the S&P. But does that make sense to everybody? Okay, excellent. So this is high probability stuff, because this tells us, you might say this is too simple. It really isn't. This is how 90% of the daily volume is making its decisions. This is what's going to drive the volume. And see, the smart money want you to think that it's so complicated. I mean, that you need to have an economics degree to be able to make money in the market, that you need software that costs thousands and thousands of dollars, that you need to spend tens of thousands of dollars on education. All of these are false. The thing that you need to be able to do is understand a simple, effective strategy and just stick to it. So based on these things, on the S&P 500, for example, this was in my personal trading account, which is not in Interactive Brokers. So we shorted that. So on October, it was October 5th actually, but the settlement date wasn't until the 10th. But regardless, we took in the larger account, we took $130,000 short position on the Russell 2000 by buying TZA, which is a triple inverted ETF. So it basically goes down by 3 times, excuse me, it goes up 3 times whatever the market drops by. So this was a screenshot early in the position. It ended up going a lot more than this, but we bought it at 924. And you can see that rallied all the way up to 1850 was its high. I liquidated half of it at $12.50, held on to another half and got rid of the rest around $15. But as you can see, worked out very, very well. Okay. We shorted the Qs as well. Same strategy. Let's have a quick look at the QQQs. See, because the QQQs actually broke down before the S&P 500 did. But once again, look at the pattern. You have a clear upward channel telling you this is a oscillating pattern getting ready to break down. 1 touch, 2 touch, 3 touches on support. There was the 4th, and there was the crash. All right. And if you look at the top, does anybody see the pattern that we have right there? At the very top of the channel? What pattern did you have? A head and shoulders. Can anyone not see that? I can draw it on a bit more clearly if you can't. Up. Right? Head and shoulders. I mean, that's really what matters most. All of the noise of the candles fades in comparison to the importance of the pattern, the power of the pattern. So really, this is what you need. This is what matters most Where is support and resistance? What pattern is it? All of this is noise. Okay. And so where did that tell us that the NASDAQ was going to break down to? Well, simple. You measure the distance from the top of the channel to the bottom, and that tells you where it's going. 148. Look at where we dropped to. Not rocket science. And it's very, very powerful, because you can then go and make confident trades with that. We put $100,000 shorting the QQQs by buying SQQQ. I show you this because I want you to know that you're listening to somebody that acts on this. What I'm talking about here is the same stuff we manage all of our accounts with. Okay. If you're an options trader, this is one of the trades that we took in that Interactive Brokers account I was showing you at the beginning. So instead of buying the stock in the smaller account, we bought options. I bought what was it? November $10 calls, which was a $8,200 investment for a $14,000 return in 2 weeks. We then, when the market bottomed, we sold them, and then when it rallied back up, as we talked about before, we got back into them and bought the January $13 calls, all based on these systems. So now let's switch from the market and talk about one other thing before we get into individual stocks and option trades. Because so far, you've heard me say the words the stock market a lot. The stock market this, the stock market that, etc., right? But this is a very, very misleading term, because there's no such thing really as the stock market. And this is what one of my mentors taught me years and years ago. It's not a stock market. It is a market of individual stocks. Because if we looked at the stock market in its classical definition, if we looked at the S&P 500, what was the best day to start shorting stocks or buying puts on stocks? What was the best day? Yep. Right here, October 2nd, October 3rd. Those were the best days if you looked at the S&P 500 to short. But let me show you why that's incorrect. One of the smart money indicators we look at is something called MMFI. In other words, what this is it's actually a graph of every single stock in the market, and it tells you how many of them are above or below their smart money support, above or below their 50-day moving average. The 50-day moving average is very important because it represents where smart money buys and sells. If a stock is falling back to its 50-day, smart money that believe that the stock's going to go higher will buy on that pullback. If a stock falls to its 50 and breaks below it, it's an indication that it's lost smart money support. It certainly means that it's going down. So if you look at the actual market of individual stocks, you'll see that on June 14th, 72% of stocks were above their 50-day moving average. By the time that the market, quote unquote, started to drop, by the time that the S&P 500 started showing any weakness, that had declined from 72% to 40% of stocks now above their 50-day. So when was the best time to start shorting stocks? June 14th. June 14th was the best time to start shorting stocks, because that's when the weak stocks, or in other words, the best shorts, started to decline. Wouldn't everyone agree? When do the weakest stocks? So let's backtrack. What kind of stocks do you want to short by buying puts or shorting the stock outright? The weakest ones. When do the weakest stocks start dropping? Before or after the S&P starts dropping? Before. So if you're constantly looking at the S&P 500, it can help, but you need to go further than that. You need to look at what the actual market is doing to give you these indications of when to get in and out. And then that takes us to then finding the individual stock plays. Am I explaining everything clearly enough so far? Can you apply the pattern to MMFI? Yes, you sure as hell can, because if you didn't see it, there was a beautiful head and shoulders. Bam. Right there. This is just one of 4 smart money indicator systems we use to predict market direction. But yeah, this was very high probability. Everything lined up perfectly. What about back in January 2018? Absolutely. January 2018 was another time where we called the market decline on January 26th or January 25th. We held this exact webinar, calling a top to the market. You can see that we had gone all the way up. So okay, let me explain this. So let me go to a weekly chart. We're going to go back 10 years, and I want you to look at this from, I think it's 75% and up. Look at this, and over the history of stocks, look at what happens when we get between 74, 75% and above. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 times. 11 times that we get to this level, that is immediately the top of the market. If you look at all of those 11 times, this is a weekly chart, the individual stocks in the market plummet from there the very next week. The very next week. 11 times we've hit this in the last 10 years. That is immediately where the market top is printed. So whenever we get to these levels, this is definitely a sell signal. There's only a few times where we haven't dropped immediately. That's here, 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 and here. In fact, you could probably count that. So 1, 2, 3, 4, 5, 6. 6 times it goes a little bit higher for a little bit longer, but the maximum length of time it continues to do that is 3 weeks. So whenever we get to this level, we are high probability immediately at a top, and at the very, very best, we're within 3 weeks of a top. And that's 100% accurate going back 10 years. Okay, all right. Look, we're going to have to move on, unfortunately. Look, this indicator alone is a 45-minute lesson that we have, and this is just one of 4 smart money systems we use to predict market direction, and it is incredibly accurate. So this is just one of 4, but hopefully that gives you the high-level analysis on what that indicator is doing. And this is why when you start talking about market direction and worrying about what the S&P 500 is doing, this is why you need to have an edge. Because you're right, in a turbulent market, you can't just be trading garbage stocks. You certainly don't want to be trading stocks that do exactly what the market does. You want to find stocks that are so weak that they will go down no matter what the market does. You want to find stocks when you're going long that are going to go up even if the market goes down. You want to find stocks that hopefully are going in the direction that the market appears to be going, but ones that have their own resilience. So let me show you those. So what stocks did we trade? What stocks did we pick? Well, check out ALGN. ALGN. Now, there's a lot of stuff that's happened since we alerted this, but so let me just try and remove a little bit of noise. But ALGN was something we alerted to our students as a short on the 5th of October. Whoops. 5th of October. So right up here, I'll bring up the alert. So that was our time-stamped alert back here, predicting that it would plummet. Now let's talk about the reasons why. Why was this so high probability, and why was this the perfect short? And as you can see, the market rallied over the last few days. Look at what this stock did. It actually went straight down, right? Well, we had a market that went up 3.25%. This stock has declined, what, 9% yesterday, or the day before, and hardly rallied at all today. Well, yesterday. So let's talk about ALGN. So ALGN, upward channel, firstly. Can everyone see the pattern? You have a high probability pattern as an upward channel. Okay, what are the rules of an upward channel? Well, we want to see 1, 2, 3 touches along support. Now it's due to break down. Okay, fantastic. If you were somebody that understood other patterns such as rising wedges, you'll also notice that you had a rising wedge at the top of the channel as well, which further indicates that that's the absolute top that this stock is going to hit and time to short. So you could have got in even higher, in fact, but we try to publish ideas that are a little less aggressive for our students, so we can obviously apply for all levels of skill. So the easiest short is to wait for it to break through the channel's support level, which we did. And right there, it became a perfect short. All right. So we have now considered the power of the pattern. But what else can we do to increase the probability of this even further? Well, let's look at the insiders. Let's go and have a look at what the owners of the company are actually doing with their own stock. And when we went to look at ALGN, well, looky. We can see that the vice president of operations, hang on, I'll get my little spotlight out. There we go. The vice president of operations was selling 60% of their stock. Then the senior vice president of operations again, 66% of what was remaining. The senior vice president of global HR, 89%. CFO, chief financial officer, sells 82%. 84%, 30%. Then the vice president of North American sales says, sell it all. I mean, come on. Would anyone in this room go and buy stock if it's chief financial officer and all the senior vice presidents all walked up to you and said, hey, buddy boy, here's a great opportunity to buy some stock from us because we're selling all of ours? What would your answer be? Hell no. But if you want to know why it's still so easy to make money with these strategies, is because so many people have no idea. Do you know how many people said, hell yeah? You know how many people said this is a great day to buy as you liquidate 100% of your stock? Well, let's just have a look. I mean, look at that. CFO, VP, the date was the 30th. It was reported on the 3rd of December. So the 3rd of December, this was public information. And on the 3rd of December, $215 million worth of people said, time to buy. But I mean, even before that, look at all of these occasions where the insiders were selling right before it gapped down, right? When did it gap down? We gapped down on the 24th of October. Right. Well, look at the August. Look at all of these sales that happened prior to that massive drop. So is this something we're going to short? Absolutely. NTAP is another great example. So let me go back to my normal charting here. I use a few different charting platforms, but NTAP, another one that we call the short on, because have a look at this. Look at the pattern. Can everybody see one? Upward channel. There's your first pattern. And we had 1, 2, 3 touches on support. So we're waiting for the breakdown. And then at the top of the channel, what did we get? Aha! A head and shoulders. Perfect. So that was where we first called the short, up at 82.50. And then it formed another head and shoulders. Perfect. It's telling you exactly where to enter, where to set your targets. We bought the March $55 puts, I think, for $1. Ended up selling. I sold those a couple of days ago for it was $4.50 or something like that. But it's perfect. And then you go and have a look at the insiders, and what were they doing? Selling. 92%, 36%, 76%, 83%. These are high probability setups. And here's another point I want to make now. So, okay, so this one was actually an options trade. So yeah, you can see PE bought the $22.50 puts, which was a $10,000 investment. And at the time of this screenshot was $5,500 reward in 3 weeks. Ended up being a lot more than that. And we rolled those December puts into, maybe I had that screenshot. Yeah, there we go. Yeah, we rolled the December puts into March puts, which we bought there at $2.13, which was already at $3.30 at the time of this screenshot, which have dropped a lot more since as well. So the other point I want to make here is coming back to, I think, Guillermo, you asked this earlier, that this isn't a swing traders market, it's day traders because of the amount of the volatility in the indexes. I would argue if you are in the right stocks, it absolutely not. This has been a fantastic swing traders market because have a look at this. Look at what the market did. The market plummeted and retraced its highs once, twice, 3 times. 3 times it recovered all of those losses. Okay, but go and have a look at ALGN. Sorry, look at ALGN. Did it recover any of its losses? Absolutely not. Did NTAP recover any of its losses? Absolutely not. Did Grubhub, another one of our shorts, recover any of its losses? Absolutely not. Look at Grubhub. Tons of selling. I mean, look at Michael Kors. Michael Kors changed its symbol, but that plummeted. Look, there's so many examples. So we're running out of time. Let me talk about our offer. I could literally talk about this for days. The key is to keep it simple. Notice that in none of these trades do we need to consider what the Fed was saying. It had nothing to do with what was going on with China. We're not looking at financials. We're simply saying, what's the pattern? That tells us where all the volume is going to go. And are the smart money doing the same thing? And that tells us the long-term picture of the fundamentals reported from the guys that know best. The owners, the CFO, the CEO. If you can do as much research as you want, but none of us are ever going to have more of an idea about what that company is going to do than the people that know. No guesswork required. Follow where they are going because they know the answer. Right? So that's what our strategy is all about. It's about creating systems where we determine market direction, creating systems, therefore, to find the best stocks or option trades going in that direction, and have a 1, 2, 3 process of defining everything from finding the stock itself in the beginning all the way through to entry and exit alerts and how to trade it. So we have a pretty awesome package that we've put together that covers absolutely everything. We actually this is a promotion we'd run for the end of last year, which we weren't going to continue into this year, but given we're so close to New Year's, we have continued to offer it tonight. This is our Smart Money Workshop, and this covers, firstly, it's 3 modules. Module 1 is where we go over the smart money systems. So I talked about MMFI earlier today. That is a whole lesson on its own, which we've just recorded last month. So it's about a 30-minute lesson which shows you exactly how to use MMFI, how to trade it, entry and exit signals, the back testing data. It's awesome. How to install it on a charting program. That MMFI is just one of 4 of our smart money indicators that we use, and each are as probable as each other. So we go through how to use them. There's standalone modules for each of those indicators, and how to set them up on your trading platform and use them. The second module is where we go into smart money patterns. So obviously, you know, what I'd like you to take away from this course, what you will take away from this course, is to be able to look at any chart and not have to guess, to know this is what probability is telling me to do, and even though your emotions might be going the totally opposite way, to allow you to make a decision because you know that out of 1,000 times this same situation has happened, 90% of the time it does this, and that, right or wrong, is what you need to do. Whether it works out in your favor or not is unimportant. And the most important thing to do is follow the rules. So you need to know what those are. So we cover the highest probability smart money patterns and how we approach those. And all of this leads up to the real cream of the crop, which is scanning for the opportunities. So we've built a special scan criteria, which you don't need none of this you need any special software for. You don't need any special program. Our scans will be able to run on third-party software, where we plug in our criteria to say, look for these high probability insider longs or shorts. And every stock we've found so far that we've talked about tonight come from these scans, where it's going to be finding these for you and saying, right, this is a stock that has the perfect pattern and has all the right insider selling. So our scan's not going to just look for insider selling, it's going to look for the CEO selling 100%, for example, as well as the CFO, the vice president, all at the same time as the perfect pattern breaking down. So it is an all-inclusive scan that finds these perfect storms in a matter of minutes, and then we show you how to actually go through these and pick out the best ones from the setups. Now, we're almost out of time here. I think we are out of time. Let me just see if I can answer any of the last questions that were there. I'm not sure, Renee, if we have a minute or 2 extra.
Yep, you're good. You can answer any questions.
Perfect. Thank you, Renee. See how good they are over at Webinar Expo? All right, let me see if I can answer some quick questions. I got carried away a little bit. What day of the week do you do the group meetings? Okay, I'll get to that. How long, when you hold a short stock that long, can you still make money with the interest the broker charges? Absolutely, 100%. I mean, when we're going short a stock, we're looking for a minimum drop of about 20 to 30% within a 6 to 8 week time frame. I mean, the interest we're paying on that is, you know, what, 2%? Mac? No, I think it's tiny. The interest is inconsequential. So as you can see, that 77% rate of return we had on our account over the last 3 months was after expense. Question. Can you, does it work on futures? The smart money systems, absolutely. I mean, obviously we're not going to be scanning for insider longs and shorts, but the smart money systems, those 4 systems that I talked about in module 1, are extremely applicable for trading futures, because they actually, one of those systems is back-tested to 1960, is 92% accurate in predicting the S&P 500 direction 3 weeks out. It's a very, very specialist system only for trading the S&P futures. I use it for predicting market direction because I'm not a futures trader. But if you were a futures trader, that is the most probable indicator you will ever find for predicting S&P direction. We use it differently as a market indicator, but if you were due to use it to trade the futures, that's in module 1, and it's called Acorn Open Range. Okay. Do we have a trade alert service? Yes. So on top of giving you the indicators, now this package, just so you know, as of next week, we'll be offering this package broken out. Each of those 4 indicators I mentioned will be sold on our website for $197 each. So just in those 4 indicators alone, in module 1, that's an $800 package. Each of these scans, the long, the short, and open range, will be a standalone module for $197. So this is a really awesome package. It was our, again, end of year special last year that gets you all of it for $197. The setups, the strategies, the scans, and what we've added as a bonus offer is if you want to follow along with our trades, we do have a trade alert service, which is something that we do throughout the week. So we send 2 to 3 weekly reports with our five favorite setups each week. So on Monday, I'll publish a video that'll say, look, these are my 5 favorite longs that I'm looking to enter. And I'll be telling you what I'm looking to put my own money in. So that account that we started a few months ago is used purely to trade Acorn only stocks. So we'll be saying, right, that's why I was trying to load up in Interactive Brokers to show you how we program those in, but it's just still attempt 60. It won't log in for some reason. But we pre-program everything. So we'll say, look, we're looking to buy this stock if it breaks above $32.10. We will sell that at $38.50, and our stop loss will be here. This is the pattern. This is the insider research. These are all the reasons why we're buying this, and these are the pre-programmed entry, exit, and stop loss levels. So very rarely will I ever action trades when the market's open. Everything I do is when the market's closed, and I pre-program everything, because one of my rules is to not watch the market during the day. I find that I make a lot more money if I just don't watch the market, set up my entry, exits, and stop losses, and let the strategy do its job. So all of my research is done when the market's closed. We send out those videos at night. We send them out about 3 times a week, along with updates on previous positions we're in and updates to stop losses and things like that. So you can add that onto your course for $9. And it also covers text message alerts, as well as Tuesday and Thursday live practical sessions where we take everything you've learned in the course and then apply them in live markets every Tuesday, Thursday afternoon. So you can add that on for $9. And at the end of the month, if you want to continue only with the alerts, it's only $59 a month. And if you want the alerts plus the ongoing training sessions every Tuesday, Thursday, it's $147. And obviously, by the end of the month, you can decide if that's something which you want to continue with. So you'll receive all of this right away on demand. Can you day trade S&P with this? Yes, you can. It's the futures strategy applies to weekly futures, weekly options on the SPY, futures, or day trading after the first half hour. Is the scanner also included? Yes, and the scanner is unlimited. Everything that in this course, Thomas and anyone else wondering, is something you have for life. There is no need to buy anything else. You own the course, you own the scan. You don't need to subscribe to anything to continue using that strategy. Could you tell me whether I am allowed to short the shares if I don't own any? Yes, you certainly can. Everything that we short is something that we don't own. If we're shorting, we're borrowing stock that we don't own to make money from the drop. And part of the scan checks to make sure that a stock is shortable before it alerts you to it. Do we have a yearly rate for the alert service? Sure. Yeah. You can, if you want to, if you have a question like that, we can look into that for you. Here you go. I'll put our contact details there on the screen. And once again, the link I'll put in the chat box for you is acornwealthcorp.com/smart. There are no continuing data fees. No. Is the add-on for the $9 applicable after the 4-week period? As long as it has to be within your first 4 weeks. I would suggest doing it now because we've just published a brand new list of stocks that both long and short that look really, really, really good. So if you're actively trading, then I would suggest there's a lot of value in following those alerts right away, but up to you. And yes, you can. So if you want to add it on later, Max, certainly. Can you pay with PayPal? Sure. Just drop us an email. Kamal, if you can drop me an email. Is there cost for data for the scanner? Absolutely not. So there you go, folks. I've taken up enough extra time from poor Renee here. But thank you so much again for sticking around. I hope we've answered all of your questions. And if you want to if there's any questions we haven't answered, give us a call or drop us an email. We'd be more than happy to help. And yeah, look, it's going to be a very, very, very exciting couple of weeks ahead, if not year ahead. So we'd love to have you as part of the community. And Max, the $9 is for is a month of the alerts.